Guys, 3 major stocks at 52-week lows. We haven't had that in a while because of this raging bull market, but I've seen a lot of requests on Twitter, people asking me for these companies, PayPal, CVS, Walgreens. We're going to take a look at them right now. Guys, we're going to go over some bull and bear cases, some high-level metrics, analyst estimates. We're going to go through our 8-pillar process very quick on them, and then we're going to finally end it with the stock analyzer tool. This will answer the question that I'm sure you're here for, which is how much should you pay for PayPal, CVS, and Walgreens? So let's take a look right now. Remember, guys, there's going to be things in here for beginners and more advanced investors and everything in between. So it doesn't matter to me where on the spectrum you fall. Stay through the entire video. You'll learn something. Beginners, it's going to sound a lot more confusing than it actually is. I was confused the first time I heard these things. Our 200,000 plus subscribers had the same feelings throughout. But as they stuck with it, things get repeated in their head and they started to understand things better. So just stick with me. I guarantee you'll understand it better. And the more you learn, the less you'll fear. That's why you got to stick with this. So let's check out PayPal to start. We're going to pull it up here. So PayPal's all-time high of 310 back in July of 2021. That's 2 years ago. And now it's at $59.09. Full disclosure, I own PayPal. Do not go buy PayPal just because I own it. I'm here to teach a process. Go do your own research. And if you like the company, buy it for your own reasons. Don't buy it just because I have it. I fully expect and want the stock to go further down than it is today, because I think we're in a raging bull market. And when that ends, a bear market's going to affect everybody. So PayPal, I expect to go down lower. $65 billion market cap if you bought all the shares outstanding. So a bull case for PayPal. They own 40% of the global payment services market and 60% of the US payment market. That is huge, guys. Huge. They just partnered with Microsoft to do some payment processing. A big partnership, because you see how much Microsoft is involved in everyone's lives. Just think about it for you. Microsoft touches you in some way, whether at work, whether at home, whatever it is on your phone, Microsoft touches your life in some way. So if Microsoft touches you in a way that's inappropriate, please call your local authorities and report them, because I know that's the very important thing lately. So anyways, back to PayPal. A good return on invested capital, not great, decent, but I think they're still investing a lot in the future. This shows that they get a decent return on the money that's invested in the business. But the one thing I do like is their PE is 16. And this is a company with a lot more growth potential. Now, guys, if you think there's anything in the company that I'm missing news-wise, since I'm going through 3 companies, drop in the comments below. Mention the company you're talking about and what news below that you are actually referencing. In the future, when we do videos on these companies, we're going to go back to these past videos and pull the comments that we like the most and put them in our new video. And we're going to give you a shout out on that video. So make sure you do that. Let's check out the 8 pillars. Oh, wow. Look at this. 8 pillars. And guys, remember, you can customize this if you have our software, up to 12 pillars and 4 quadrillion different variations. The only X here is cash flow is down over the last 5 years, even though income is up and revenue is up. Okay, so my first question is, as an investor, why the heck is it down? Let's go look at the cash flow statement and see if it can tell us anything. Because remember, that's what the 8 pillars are here for. They're to tell a story and to ask questions based on what you see. So let's see here. All right, a big drop in cash from operations. They had a big year in cash from operations back in 2019. So it's probably just coming off of, all right, interesting, because their capital expenditures are down. So the question is, we're looking at this free cash flow. It went from 7.2 to 4.3 to 5.2 to 4.6 and down to 3.7 billion. Is this the start of a trend downward? That's the question to ask yourself. That's the question to ask yourself. But keep in mind, guys, that they didn't have an all-time high free cash flow when they were selling for their all-time high. That was years before. So remember, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. In the short run, the popular stocks are going to go up. The unpopular ones are going to go down. But in the long run, as long as you pay a reasonable price today for the company, whatever that may be, wherever the company goes, you will go. If they increase their revenue, profit, and cash flow, so will the stock price. And that's the key there. That's my entire investment thesis, as simple as it may be. But I want you to remember those, okay? So let's see what analysts are saying about PayPal. They expect PayPal to make $5 a share this year, increasing to $9 in 4 years. Pretty big growth, guys, double digit every single year. And revenue growth, close to double digit, but going from 30 billion this year to 46, a 50% increase over the next 4 years. So we're going to use Stock Analyzer tool to determine what price to pay for the stock. Now, I'm actually going to pull up my last PayPal in our history here, because I can go to our history, pull up PayPal, and the last one was August 9th at 9:32 a.m. I'm going to pull it up. These are my assumptions. 4, 7, and 10% revenue growth. Okay? 4 seems pretty unlikely. 10 seems like it'll be hard. And 7's probably where it's going to end up based on reasonable assumptions. Profit margin, I just looked at the past and went a little bit lower. See that it's increasing, so maybe it'll get better, and a really big number, and down the line. Now, one of the things I did that I want you to see, I put in pretty high desired returns, 12, 13.5, and 15%. And the reason being, even though PayPal dominates their market, there is a lot of competition there. There's a lot of competition in the financial market. And so I want to be paid for that competition. I want to put my buffer in, my margin of safety. That's why I put in 12, 13.5, and 15%. The higher I make my annualized return, the more margin of safety I'm putting in there. All right? So let's hit the analyze button. Boom. We got a low price of 40 to 50, high price of 105 to 120, middle price of 68 to 83. If I pay today's price and the lowest assumptions occur, I'm going to make about 10.5%. The middle assumptions occur, 19%. And if the high assumptions occur, 26%. So guys, again, don't buy it just because of these numbers. Go do more research and make sure you're okay holding PayPal through thick and thin. Because there's a lot of negative news out there in PayPal. But you got to remember, news always follows the stock price. So I'm wondering, is the negative news real, or is it because the stock is down 80% from its high? All right, let's pull up the next one, CVS. So some high-level metrics on CVS. First off, it's down year-to-date 28%. Okay, $86 billion company, revenue of $340 billion. Guys, look at this profit margin. They're a very low margin business. Very low. 0.9% in the last year, last 5 years, 2.2%, and their gross margin is only 16%. That's lower than Tesla. What that means is every extra dollar they sell, they're only sending 16% of that, 16 cents of it, to the bottom line before taxes. Okay. Bad return on invested capital, but here's the attractive part. This dividend, 3.5%, ate up $3 billion of their free cash flow. Now, here's what I want you guys to remember and look at this. Last year's free cash flow was $17.7 billion. Last 5 years average free cash flow is $13.5 billion. But look at their income. $3 billion in the last year versus 17, and $6 billion in the last 5 years versus 13.5. Those are big, big differences. Their free cash flow margin is much, much higher. Their price to free cash flow is 4.7, while their PE is 29.4. So why is there a big difference between net income and free cash flow? Well, net income has a lot more rules and how you deduct things, how you expense things, etc. Free cash flow, cash in, cash out, cash from operations, minus your capital expenditures. And what are the capital expenditures? It's the money being invested in the fixed assets of the business. This is usually a lower number than the net income or at the net income number. The fact that this is so different is pretty amazing. Let's go look at it. Let's pull up cash flow. Let's just go to their annual one. Yeah, look at this. Incredible. They've averaged $12 billion annually. And over the last 12 months, they've averaged 13. That's incredible. Incredible. Big numbers, guys. So the question is, look at this big jump that happened. Look at the big jump that happened. 8.5 to 13, 11.6, 15.8, 17.67. Big jumps. Changes in working capital were big. But even taking those out and stabilizing them, they still did great numbers. All right, so this could be a value play. All right, let's see what analyst estimates are saying. Oh, wow, okay. $8.67 this year, they expect per share in profit, going to $11.40 in the next 4 years. So not great growth, but high single digits. Okay, nothing to write home about, but it's CVS still. Revenue, not much growth there. Not much growth at all. But the medical field, they're starting to become more and more into the medical field. I personally love the idea of having a CVS that can see me very quickly for very short-term, very small ailments. I don't need to go to the doctor if I have a flu or a cold. I want to go to someplace quick with a nurse practitioner or something like that to get me my information. And I think that's the world next with Walgreens and CVS. And Walgreens we're going to do next. So what price to pay for CVS? Let's see what my last time doing CVS in our stock analyzer tool was. Oh, January 30th, 2023. Wowza. I did a 20-year analysis. Let's go to 10 years. And my assumptions were 3, 4.5, and 6% revenue growth. Okay, that's lower than the analysts are expecting. Profit margin, I did 1.752 and 2.25. Free cash flow, a lot higher. As you can see here, this is what they did in the last 10 years, 5 years and 1 year. So I did 4, 4.5, and 5. PE, 14, 15, 16, 14, 15, 16. My desired return, 11, 13, 15. All right. So I'm at the analyze button here for the new numbers. The stock's currently at $66 a share. Wow. Green all around. I understand why people are asking me this question now. Potential 23% return, 28% return, and 33% return on this company based on the cash flow. So our current price return goes based on cash flow, not earnings. But guys, even on earnings, it's pretty much there. Guys, I would recommend doing more research on this one. Understand this company. I know I'm going to add it to my list. I'm actually going to add it to my watch list here at $60 to remind me if it gets stupid low to do more research and figure out if I want to own this company. And the great thing is when I add it to my watch list, it's going to send me a notification on my app, on my email, and on the software saying, Paul, check out CVS. It went below your strike price. That's the great thing about our software. All right, let's go to the final one, Walgreens, WBA. Boy, Walgreens is down a ton. Year to date, 27%, close to CVS. Last year, 55%. The stock's at $26 a share. This is the part about Walgreens everybody's going to love. Look at this dividend. 7.3%. 5-year average free cash flow, $3.3 billion. Last year, negative $800. And their dividends cost $1.7 billion. So as long as they get back to free cash flow, they can afford this dividend. And it's a big dividend, but I would be careful that if this is this negative free cash flow, if this is a consistent thing for the company, something to be careful about. Something to be careful about. In years past, Walgreens was more attractive to me than CVS, but CVS has really dropped a lot. I don't own either company right now, but CVS is piquing my interest a lot more than Walgreens right here. So for me, I know I have to do more research on the company, and I'm going to go in the community and ask some people in the community who've been paying attention to it, what do they like about CVS? Because I used to get the question, Paul, why do you like Walgreens more than CVS? It was valuation. Because let's go back to CVS real quick. Let's see what its all-time high was. All-time high was 113 back in 2015. Even in December, it was 105, and now it's at $66 a share. So I got to figure out why the market is soured on CVS so much. So some of the issues with Walgreens, their interest expenses increased 18% due to 2 recent acquisitions they used debt to buy. Remember, guys, interest rates have gone up a lot. So when you're using debt now to buy things, you have a much higher threshold than they did before. Also, their operating income has fallen 31%, but those were mostly from acquisition charges. Remember, when a company has one-time charges, just like one-time gains, you can't really factor that into the company. Acquisition charges are going to happen, and they amortize them out over periods of time. Now to Walgreens. Now Walgreens has fallen behind CVS in terms of the market share. So that's a big deal for Walgreens. I like both CVS and Walgreens. I never go to Rite Aid. I don't even know how Rite Aid, if I see a Rite Aid, I'm like, oh, there's still Rite Aids. I mean, I just don't ever go there. CVS and Walgreens dominate our Northeast Ohio market. I love them. But for Walgreens, let's go see the 8 pillars, see how it looks. Oh boy, that's bad. That's really, really bad, guys. Now, the multiples are really good, though. 7 times free cash flow, 11 times PE. Buying back shares that, for Walgreens, it's a $23 billion market cap business. Wow, it's down so much. A lot of the enterprise value difference, $23 billion versus $90 billion, all this debt. The difference between these two is basically the debt. They got leases. Walgreens and CVS have very, very expensive leases because they want prime real estate. They want to be that imagine the busiest corner in your city, in your neighborhood. There's probably a CVS or a Walgreens there right now. Now, some positives to Walgreens, their gross margin's higher than CVS. Remember, CVS was 16%. Walgreens at 19.84. That's a positive for Walgreens, but this profit is just abysmal. This dividend is very attractive, but make sure the company can explain these cash flow problems and they can get back to paying this get back to making sure this dividend is more stable. because that is a good dividend. The question is Walgreens going to be able to maintain that dividend going forward? Just because a company pays a dividend doesn't mean it's always going to be safe. That's what we want everybody to remember. We always teach that here. Dividends should be compared to the free cash flow. If the free cash flow if the dividend eats up over 50% of the free cash flow, make sure the cash flow is consistent and steady. Here, I do not see that. I do not see, this concerns me. Let's go to their cash flow statement and see how their cash flow has been the last 5 years. All right, a lot more stable, guys. So this is probably a fluke year. That's a big drop in free cash flow. Big drop. Okay, change in receivables, change in working capital. Deferred taxes was a big thing. And operating gains and losses were a big thing. Yeah, that's the operating margin. So guys, let's go look at Stock Analyzer tool. Something tells me this is going to be huge. Let's pull up the last time we did Walgreens back in May 2nd. I'm going to do a 10-year analysis versus I did a 20-year before. Let me say, what were analyst estimates on Walgreens? We forgot about analyst estimates. $4 a share this year, going to $6.20 in 3 or 4 years. And revenue, actually going pretty solid. 4-5% a year. All right, so let's go to Stock Analyzer tool. What price should we pay today for Walgreens? Profit margin, I did so revenue growth, I did 2, 4, and 6%. About reasonable for what the analysts are expecting. Profit margin, 1.75, 2.25, 2.75. And just like CVS, Walgreens has higher free cash flow than their profit. Big plus there. PE, I put a really low PE, 10, 12 and a half, and 15. Trying to be really conservative there. And I did a desired return of 12. Wow, so I really beat this thing up. Analyze, holy cow. This is interesting. And I have it on my watch list at $25. If you have our software, you just hit the plus mark right here. And you just put in what amount you want to put it in. Put 25, notify me. And now, again, on your software, on your computer, on your email, you'll get notification for when the stock hits that price. But we have a low price of 26 to 38, high price of 51 to 66, and a middle price of 38. Guys, very high potential here with CVS and Walgreens. I could see the play of saying, let me buy both of them and see which one wins. Maybe. Again, I'm not telling you what to do here. If you understand the business, focus on that and make the right decision for yourself. It's not going to come from me, but what I can teach you is a process. And 200,000 people have chosen to subscribe for that reason. Thank you for your time.